Hey, welcome back. This is Patrick Badalato. We're going to continue to cover the statement of cash flows. This one, I want to emphasize, please check out the prior video, the topic 2.4a, where I cover a more general introduction and get into this specifically with Pepsi. I'm going to do this one, will be shorter and just kind of echo some of those points with Chipotle to show a different company, a different angle. But this one more than the others, like you really want to listen to, pay attention to the first one where I covered the general idea and cover all these aspects before covering this particular one. So with that in mind, let's jump into it. We're going to just talk about their operating section. In this case, Chipotle's. We've already done Pepsi, but worth seeing both of these. So what do we have here? Like Pepsi, we have the split in like two sections, not literally in half, as I mentioned before. The top half is these, and actually, sorry, this is what I wanted to do. I like that Chipotle says this. Companies don't all do this. They use different subtotals and labels. There's no standardized way or single way of doing this, but I like that Chipotle and other companies too just directly state what's going on here. So the top half, as I showed with Pepsi, I want to show here with Chipotle, is I just like they literally state what it is. And to me, that helps. I just, be literal, be direct. Don't do all the fluffy marketing and weird stuff we see with financial metrics and interpreting them and using them and trying to mislead. Adjustments to reconcile net income to net cash provided by operating activities. That's exactly what this is. It's a series of bookkeeping adjustments to arrive at cash provided by operating activities. And the first half is related to things that affected net income. And the second half is related to changes in operating assets and liabilities. If you remember from the Pepsi thing, they just said change in assets and liabilities. I'm being super nitpicky, but that's technically not true, right? It's change in operating assets and liabilities. There's no big issue there. Established user of financial statements would naturally translate that in their own head. So I'm not arguing that Pepsi did anything wrong, but just, hey, when we're learning this stuff, getting that being specific, being direct, being literal is a huge help. That's why I have Chipotle in here. I'll make sure we're clear on that. So they actually also have fewer adjustments in the first section, but like Pepsi, they have things where depreciation and amortization. What does that mean? I'm not going to recover this in the same level of detail, but that's an expense that decreased net income. So they adjust it out because when the bookkeeping system recorded that entry, there was no decrease to the cash account. Deferred income tax provision. Well, that's a more complex one to be clear, but because it's a negative adjustment, that actually means, I'm going to try to say this, in a somewhat accessible manner, their tax situation, whatever it was, actually during that period increased the net income. And here they adjust it out by subtracting it. So it increased net income, their unique tax position. We're not debating whether it was good or bad, whatever else, but I'm just telling you what happened. Purely descriptive here. Their unique tax position increased net income. We adjust it out by decreasing it $43 million. All right. Impairments, those work the same way as depreciation and amortization. They decrease net income. Bookkeeping, no decrease to the cash account. We're going to add that back. Provision for credit losses, that works the same way as deferred income tax provision. It decreased net income, we add it back. I said that wrong. It increased net income, we add it back. Stock-based compensation expense, pretty common these days with lots of companies. That one decreased net income. It's effectively wage and salary expense, and it did, but it doesn't involve, in a bookkeeping sense, a direct decrease to cash when you record the entry. So that's what we have, right, in our first section. Second section, like Pepsi, is the changes across the assets. As we said with inventory, and this is not a bad or negative thing, inventory usually has a negative adjustment. What does that mean? Inventory is going up. Which years did inventory go up? All of them. For which companies? Both Pepsi and Chipotle. But that makes sense. Over time, the inventory, absent some external event, whatever else, you'd expect the inventory goes up. Hopefully not by some crazy amount, that might be a problem, but like consistently going up. So what does that mean? As our inventory goes up on the balance sheet, as we have more inventory at our restaurants, whatever else we have, and then we're going to have less cash. More inventory translates on the statement of cash flows to less cash. So those amounts associated with inventory are saying that inventory keeps going up. Accounts receivable work the same way. Their accounts receivable is going up, and therefore it's going to translate to less cash. Prepaid expenses work the same way. As assets go up, that translates to less cash. So we're not saying inventory is negative. We're saying the change in inventory during the year, the change in prepaid expenses during the year, the change in accounts receivable during the year translates to an adjustment for less cash on hand for Chipotle. I get it. It's more complex. I covered that extensively in the first one with Pepsi, but unfortunately, that's what we have. Yes, it's a bookkeeping a focused statement, but it gets us pieces of information we need. So, just bear with us that, it's still valuable overall, even if it's complex and confusing and doesn't seem like it's as clearly tied to the business as the other two financial statements. All right. Operating lease assets. That one's actually a positive adjustment. And it's related to actually the total position there. It might be a tough one to discuss right now. Let's jump to accounts payable, accrued payroll, accrued liabilities. We actually see movements in both directions here. When our liabilities go up, we're actually conserving cash. So we have a positive adjustment on our statement of cash flows. And we see that in some of these years, accounts payable, accrued payroll, and benefits. In some, but not all those years, it's a positive adjustment. But I like this for this reason too. In actually other years, the liabilities, accounts payable, accrued payroll, accrued liabilities are negative adjustments. So what does that mean? Sometimes their liabilities are going up, translates to saving more or conserving cash. Sometimes the liabilities go down, translates to using up cash, basically paying their employees, paying their suppliers and accounts payable, paying their other expenses that they had on account in accrued liabilities. So you see both directions. More of an asset translates to less cash. Less of an asset translates to more cash. Conversely, more of a liability translates to saving or conserving cash. Less of a liability is paying down our bills. Right? And that works out for all of these. Without getting into all the specific ones, that's the general idea. What do we see here? These are the cash from Chipotle's day-to-day operations. First half-ish, adjustments to net income to make the bookkeeping changes for things where the bookkeeping system didn't decrease or increase the cash account. Second one, true up our variety of assets and liabilities to show how the change in the asset or liability on the balance sheet translates to a change in the statement of cash flows. Let's jump to their investing and financing section. So the investing section, as I said with PepsiCo, is day-to-day investment. I said that wrong. Operating is day-to-day and operating decisions. Let me go back to that actually. Payroll, suppliers, inventory, accounts receivable, stuff like that. Conversely, the investing section is actually not going to be day-to-day. It's going to be longer-term stuff. And they have fewer things here, which might make it a little bit more accessible. What are the longer-term investments that Chipotle made? Let's go through all of these. Purchase of leasehold improvements, property, and equipment. Well, what are they doing? They're both purchasing property and equipment, and they're spending cash to make longer-term leasehold improvements. An example, putting in flooring at a store, putting in light fixtures at a store. It's not a part of like the thing they rent it. They probably rent it like an empty space, but they're obviously spending cash, or you could say capital, to make these places, make the Chipotle stores nice. I'm confident if you've been to one of these, you've never walked in, concrete floor, exposed studs, exposed plumbing, exposed electrical. Like there's no way, unless you're actually a contractor who works for Chipotle, there's no way that you as a customer of Chipotle walked into a Chipotle and saw it like that. So that's what a leasehold improvement is. They make those places look like nice restaurants once they rent the space. That's a leasehold improvement. They spend $479 million on that in fiscal year 2022. Purchase of investments and maturities of investments. This goes back to what we saw with Pepsi. Companies like us can invest in stocks, bonds, mutual funds, CDs, ETFs, any of those things. And if you don't even know what all those things are, that's okay. They, like us, can invest in things, right? This isn't like this can't be a checking account cash, but it would be them investing in treasury bill, them investing in a mutual fund, them investing in, the S&P 500 index in a Vanguard account or whatever it is, right? They're probably not actually doing that, but that's what it would be for us. When it's a negative number, it's going to be they're spending cash to buy more of these assets, financial assets. When it's a positive number, it means that during that period, they sold off some of those assets. Right? Proceeds from the sale, they didn't have any sales in 2022, but they did have some small sales in 2021. And acquisitions of equity method investments. There's different types of acquisitions. I don't want to get into that right now, but that's simply what? Spending money to buy either a whole company or a part of a company. That's what we have there. They didn't have it in 2022 or 2021, but they did have it in 2020. Right? So those are the uses of cash and the sources, if they have positive numbers, for their longer term decisions. Let's jump into financing section. Remember, cash flows related to external financing. Acquisition of treasury stock. What does that mean? Chipotle spent money to basically repurchase their shares. They're holding them in treasury, but that doesn't really make that big of a difference for us, the non-accountants. I'm just trying to pretend to be a non-accountant because it's a dreadful thing to be as an actual accountant. The acquisition of treasury stock is going to be the amount they spent to repurchase their own shares. Tax withholding on stock-based compensation awards, I'm going to leave that one out. But that's just the incremental amount they had to spend related to their equity award arrangements. And other financing activities. Well, you see these other accounts, and I've actually skipped them in the statement of cash flows. That, like the balance sheet and the income statement, is just like an aggregation of a bunch of things that on their own are small, but they still have to report them. So I don't actually know what's in their other financing activities. That might be small enough where even if I read the footnotes, I wouldn't know. And there are some things you don't know, but I would also say that, yeah, but that's not that big where I, the outsider, understanding the financial statements, is going to be too worried about that. I want to make sure I understand the big movements. And this is true for all financial statements as we wrap this up. But there are some items where you're like, yeah, it's there. It has to be there for completeness, but it's not going to make or break my decision. Again, this is not investing advice in any way. This is just purely descriptive, but there's no way that whether that was 294 or 295, for example, that I would go long to short and investing in Chipotle. That's an impossible outcome. Small changes in other accounts shouldn't be switching our investment theses. Anyway. So what do we have there? In their case, they're actually all outflows, which is fine. It's fine for a company that's an established company. They're doing what effectively? If you look at them collectively, they're basically just returning cash to their providers of equity capital. There's nothing here about debt, unlike Pepsi. That's also fine. So there's no movement with respect to their debt. Is not good or bad. I just want to point that out. Theirs is entirely related to equity, which is fine. It's just a returning of equity. What does this tell us? Just a little bit of financial statement analysis here. It tells us something I hope we kind of knew, that Chipotle is not a brand new company. There's no way that section, financing activities, would be the result of a brand new company. And so what do we have there is it's fun. It's an expected result for an established company like Chipotle is now. And it would be unexpected if they were truly brand new. I mean, like in their first 2 or 3 years of operations. Right? And that's it. That's our statement of cash flows. Cash from day-to-day operations, cash from longer-term investments, cash from external financing. We have inflows and outflows. We have a series of adjustments. They have to adjust things to offset bookkeeping aspects of it all. Still complex. I think Chipotle is a little easier. So if you're able to work through Pepsi first, good, and then kind of look at Chipotle, hopefully there's some familiarity here, makes it feel a little bit better. It's still challenging. There's no easy way to do this. The involvement of the statement of cash flows, given its focus on adjustments, given the fact that it's not exactly the business itself, it's the translation of cash, extremely important to understand that translation line by line, section by section, but usually significantly more complex. So with that, hopefully this works out. We'll definitely cover more of all the financial statements, get into financial statement analysis, give some comparisons across time, deeper dives, etc. But I just wanted to kind of cover the basic idea of hey, here it is, and describe what's there so we get some familiarity with it. One more down, 10,000 more to go. Take care.